Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. The central government has extended its free food grain scheme for another 3 months till December. Started in April 2020 when the country first came in the grip of COVID-19 pandemic, Prime Minister Garib Kalyan Anna Yojana helped millions tied over the crisis. Some had lost their jobs, others were not earning enough to feed their families. Now, over 2 years later, when the pandemic has waned and the economy has opened up, do we still need this scheme? And will this additional outlay increase the fiscal pressure? Let us find out.
Ahead of major festivals and assembly elections in Gujarat and Himachal Pradesh, the Union Cabinet on Wednesday approved the extension of Pradhan Mantri Garib Kalyan Anna Yojana or PMGKAY for another 3 months from October to December 2022. Launched in April 2020 during the first wave of the pandemic, the scheme extends 5 kg of wheat or rice per person per month free of cost to all beneficiaries of the National Food Security Act, estimated at 80 crore. This is in addition to their regular monthly quota of food grains under NFSA. The latest extension, dubbed the 7th phase of PMGKAY, entails an additional expenditure of 44,762 crore rupees over and above the budgeted food subsidy for FY23. Phase 6 from April to September 2022 cost the exchequer almost 86,000 crore rupees. For all phases, the overall expenditure of the scheme will swell to about 3.91 trillion rupees. And with phase 7, estimated expenditure on food subsidy this fiscal would be 3.38 trillion rupees against the budgeted 2.07 trillion. But the government could see some savings in procurement and carrying cost this year due to a decline in wheat purchases. Also, considering the healthy collections in direct and indirect taxes so far, the impact of the additional outlay should not be very stark. Direct tax collections are on track to exceed the budget target. The centre is counting primarily on strong tax collections this year to maintain its FY23 fiscal deficit target of 6.4% of GDP. Its subsidy and welfare spending commitments have increased due to inflationary pressures and supply chain disruptions triggered by the Ukraine war. Economist Vivek Kumar explains if the scheme's continuation and additional outlay can put pressure on fiscal management.
This is only one of the factors which will create pressures on the deviation of the fiscal deficit from the actual target of 6.4. For example, there is also an issue of having extended government extending subsidies. That itself is more than a 1 lakh crore additional spending that the government is doing vis-a-vis what they had budgeted. But on the positive side, the government is doing much better than what they had budgeted on the taxes front. They've garnered a little bit of extra cushion on telecom spectrum auction. They've garnered a little bit of extra cushion on lower procurement of wheat because the wheat output had fallen last year. So these are some of the savings that the government has done, and taxes are doing much better. All said and done, government will, towards the end of the day, if the pressure arises, they can tweak revenue spending or in fact even capital spending to that extent to meet the budgetary numbers. Last but not the least will be the nominal GDP growth. So government had taken an assumption of I think 11.1% or thereabout, whereas the actual situation could be much higher because of inflation. Your nominal GDP growth could be close to 16%. So what will happen is when you're publishing a fiscal deficit ratio, your denominator will be much higher than what you had projected. In our calculation, the denominator alone will give you a 40 basis points of cushion.
A day before the cabinet decision, the Finance Ministry's Department of Expenditure objected to the extension in an office memorandum sent to the Ministry of Consumer Affairs, Food and Public Distribution. It said that since the COVID-19 pandemic had subsided considerably, the reasons for which the earlier extensions were given do not hold anymore, adding that the financial implication was a substantial one. The note flagged existing fiscal concerns due to the war in Europe, its impact on fuel prices, and the consequent rise in other subsidies. The department suggested a reduction in quantity if the Food Ministry still decided to go ahead with the continuation of the scheme. Continuation of PMGKAY over a long period of time may give an impression of its permanent or indefinite continuation and make it difficult to stop, the office memorandum added. But does the financial distress caused by COVID still persist? Professor Deepa Sinha, who is actively involved with the Right to Food campaign, tells whether the scheme's extension is warranted, at least in the short term, despite COVID-19 cases abating.
As we know that in the last 2 years, this has been one of the most effective relief schemes that the government has been running towards softening the impact of COVID on unemployment for the poor. In my opinion, I think it is very much needed that the scheme is continued, at least in the present situation, because although the COVID infections have gone down, the economic impact has not gone down. And in fact, what we are finding is that people are now reeling under a double pressure because food inflation is something that is new. It did not exist in the first year of COVID and is something that happened later. And there has been an inflation in cereal prices as well, whereas unemployment and wages have not really taken off yet. What we are seeing is that because these 10 kgs of cereal is available, basic food security is met. Even if they earn nothing in a day, they have grains in the house. And this is one of the things that can help people, in fact, come out of distress, because it's also an implicit income transfer. Also, that we still have a large amount of food stocks. So the only difference that happens is an accounting difference. I mean, government has already purchased this grain. It is there in FCI. It now shows in your account books as a budgetary expenditure, right? So actually, in effect, I don't think it is such a big concern, and I think it really needs to be continued.
There are still people who need such support, and the government, which appears to have some limited leeway left, has acted accordingly. It appears that the government is trying to strike a delicate balance between providing relief to those who need it the most without upsetting its fiscal math too much.
The country's two most economically backward states, UP and Bihar, get the maximum quota of the food grain scheme. They also send out a large number of engineering graduates to IITs and other colleges. The contrast tells a lot about their education system. Other parts of the country are no better. Hundreds of engineering colleges churn out over 15 lakh techies every year, but just over 2 lakh land jobs. Our next report tells more about these colleges and looks at why employability of engineers is so low.
The results of the IIT entrance exam JEE Advanced, released on September 11, showed that the IIT Delhi zone had the most number of candidates in the top 500 with 133, followed closely by IIT Madras zone with 132 candidates and the IIT Bombay zone with 126 candidates. And in the top 10 list, IIT Madras Circle was ahead with 5 candidates, followed by IIT Bombay zone at 3 and IIT Delhi and Kharagpur zones, each claiming 1 spot. Uttar Pradesh emerged as the top state with 3,864 qualifying candidates, while Rajasthan, home to the tuition hub of Kota, took the second spot with 3,339 candidates. Maharashtra is sending 3,036 candidates to IITs, whereas coaching hubs of Andhra Pradesh and Telangana ranked 4th and 5th. Tamil Nadu, which boasts of the highest annual enrollment into various engineering courses, does not feature in the top 5. In the 2017-18 academic year, about 1.58 lakh students enrolled in UG and PG courses in the engineering and technology domain in the state. Andhra Pradesh followed it with 1.01 lakh students. Maharashtra comes next with 1 lakh enrollments. Half of all the engineering seats in India are located in the 5 southern states, namely Andhra Pradesh, Telangana, Tamil Nadu, Karnataka, and Kerala. The rest of the seats are fairly well distributed across the country. But the all India capacity utilization is as low as 49.2%. While the approved engineering seats in 2017-18 was 16.6 lakh, the number of students who enrolled was 8.18 lakh. This indicates the supply of engineering seats exceeds the demand for the same. In 2013-14, enrollment was 59% of the total capacity. States with lower number of seats have reported higher enrollment percentages, while states with larger capacities have reported lower percentage of enrollment in engineering, with Karnataka being an exception. The enrollment percentage in Tamil Nadu, which had 3.02 lakh engineering seats in 2017-18, was just 53%, while Karnataka's was 65%. Delhi, with about 10,700 seats, had an enrollment ratio of 79%. Overall, the number of students who found placement at the end of the academic year was 3.45 lakh, or about 42% of the total number of students who enrolled in engineering. This is an increase from 29% of students placed in 2013-14. Now comes the most crucial factor, the employability. A NASSCOM survey in 2019 had revealed that out of about 15 lakh engineering graduates, which India churns out every year, only 2.5 lakh land jobs. The National Employability Report for Engineers 2019 by SHL shows that employability of engineers in IT services companies is just 16.25% and 3.4% for IT products. It goes as high as 39% for non-tech roles like ITES or BPO associate. This report was based on a sample of more than 1.7 lakh engineering students from 750 plus engineering colleges across multiple Indian states. The report indicates that students from Bihar, Jharkhand, Delhi, Haryana, and West Bengal have the highest employability in IT services roles. Odisha, Telangana, Uttarakhand, and Uttar Pradesh form the next tier in employability. Chhattisgarh, Karnataka, Punjab, and Rajasthan fell in the third category. Tamil Nadu, Gujarat, Andhra Pradesh, Madhya Pradesh, and Maharashtra were in the bottom 25 percentile bin. States with the highest number of colleges show the lowest percent employability. The proliferation of engineering colleges in southern India has brought down its employability figures. Employability in Delhi is the highest among metros, followed by Kolkata. Chennai has the lowest employability among metros. The capital of Tamil Nadu has more than twice as many colleges as Delhi. So why do most of the engineers don't fit the bill when it comes to hiring? There have been questions raised about the quality of India's engineering pool, except for IIT passouts.
Students who are from the industrialized states like Maharashtra, Tamil Nadu, Karnataka are highly employable. When you look at engineering, I think the opportunities for the students to do their internships is higher in these industrialized states because there are opportunities available. And hence, I think that exposure is extremely essential to get the hand-on experience to what you are learning. We talk about the applied knowledge. And I think that's something which every student, be it technical or a non-technical, it's absolutely critical. Institute may be in a highly industrialized state or a location, but if it's not been able to build a bank of industrial relationships and it's not leveraging on that, I don't think so today any educational institute, be it engineering or any other, I would say, that can survive in today's state. The curriculum, the way it's been built up, how much of inputs have they taken or collaboration has happened with the industry in designing and executing the program, I think that's very essential. There have been a lot of engineering colleges which have shut shop because they were basically money-making machines. But you realize that if you're not being able to focus on the quality of the education, if you can't offer the placements and enhance the employability factor, obviously they start losing their attraction.
While employable engineers as a percentage of graduates are low in states with large intake capacity, such states also produce a decent number of productive employees owing to their industrialization. Employability should be assessed on an institute-to-institute basis, with regulators requiring each to develop a bank of industrial connections. This can also address the issue of needless capacity addition in this area.
A recent report said that startups are paying more to engineers than big techs. But the global slowdown is forcing startups to do a reality check. It is also forcing banks to act tough. The US Federal Reserve's aggressive monetary tightening policy has also spelled more trouble for the crypto markets. While analysts in June had anticipated a mild recovery in the second half of the current fiscal year, crypto investors continue to bleed. Our next report tells about the road ahead for the crypto markets as global central banks affirm their commitment to high interest rates.
Global recession fears, stronger dollar, higher interest rates, and spike in bond yields are building pressure over the crypto markets. Since crypto markets move in tandem with global equity markets, the ongoing volatility in the US markets have cast a shadow on cryptocurrencies as well. All the three major indexes in the US markets like Dow Jones, Nasdaq Composite, and the S&P 500 have shed in the range of 19% to 30% so far this year. Therefore, the promise of more rate hikes proclaimed by the US Fed till 2023 is likely to keep crypto markets volatile too. According to CoinMarketCap.com, the global market capitalization of crypto assets has tumbled over 57% to $935 billion so far this year. Popular crypto asset Bitcoin, for instance, has tanked nearly 60% so far in 2022. Other assets like Ethereum, BNB, Solana, Dogecoin, and Polkadot have declined in the range of 46% to 81% during the same period. Analysts believe that the reduced risk appetite among investors compelled them to shift to less riskier assets like bonds. Going forward, they expect the volatility in crypto markets to continue in the near term.
Market will continue to be weak as long as Fed continues to raise rates and investors do not anticipate an end to the interest rates. One might argue that now that we have hit a 2-year low, the market should start finding a support. But when you have these cascades of selling, like we have seen since the Fed, really the support doesn't matter, and you can just slice through it. And it'll be interesting to see where the market sort of bottoms in the times to come. Specific to crypto, I think crypto markets also continue to sort of be sideways. Bitcoin has been primarily operating between 18,000 to 21,000 range. What I've been most excited about in the crypto space now is Ethereum. Since the last couple of weeks, we have been seeing a successful running blockchain on it after the Ethereum merge. And I think from an economics point of view, the net issuance of Ethereum has gone down from about 3.5% to less than 0.5%, which I believe is great in the long term. Now, this basically means that along with Bitcoin, Ethereum is one of the most deflationary assets, not just in crypto today, in fact, but across investment options available globally, given the high rates.
On the other hand, Devanshu Datta, independent market expert, says that the lack of any fundamental benchmark makes crypto assets a riskier bet to hold for the long-term horizon.
And if you're talking about how much the downside for Bitcoin could be, it could be anything. It could be 70%, 80%, 90%, 99%. All of that is possible. You don't have a fundamental benchmark of any kind now. It's a question of do people see this as a possible long-term asset, or are they just going to get rid of it?
Meanwhile, technical charts suggest a death cross pattern for Bitcoin, which signals a bearish market ahead.
After hitting a historic peak of $68,990 in November last year, the first digital currency Bitcoin plunged under 2014 lows of $29,900 in this May 2022. At present, the currency has lost 70% of its value and trade with extreme bearishness. Besides having double top formation on the weekly chart, BTC, the trading symbol of Bitcoin, has formed a death cross, a short-term bearish signal where 20 weekly moving average has breached 200 weekly moving average on downside. Technically, Death cross formation points at an elevated bearish trap with currency expecting more sell-off. From now on, if BTC violates the recent pullback level of $17,630, then it might fall to 15,000 in near future. To negate this death cross, Bitcoin needs to absorb selling prevailing in the range of 25,000 to 30,000, which was the double top breakdown range.
As regards today, investors will closely track the Reserve Bank of India's interest rate stance post the 3-day Monetary Policy Committee meeting. According to experts, the central bank is likely to raise interest rates up to 50 basis points. FII flows, rupee movement, and crude oil prices will also be on investors' radar.
After the markets, let us step into the corridors of the Supreme Court. On Thursday, it ruled that all women, irrespective of their marital status, are entitled to legal abortion as permitted under the medical termination of pregnancy rules. The verdict has addressed some grey areas in legal abortion in India vis-a-vis unmarried women. Our next report does a deep dive.
It all started with the petition of a 25-year-old woman from Manipur. She had approached the Delhi High Court seeking permission to terminate her pregnancy before the completion of 24 weeks on 15th July 2022. The reason? Her partner had refused to marry her at the last stage. She told court that she did not want to carry the pregnancy to term since she was wary of the social stigma and harassment pertaining to unmarried single parents, especially women. The High Court refused interim relief to her. Its division bench observed that since the appellant was an unmarried woman whose pregnancy arose out of a consensual relationship, her case is clearly not covered by any of the clauses under the Medical Termination of Pregnancy Rules 2003. MTP rules allow minors, survivors of rape, women whose marital status changed during pregnancy, mentally ill women, or women with fetus deformity to terminate pregnancy till 24 weeks. In case of pregnancy due to consensual relationship, termination of pregnancy is allowed only up to 20 weeks. The woman approached the Supreme Court then, which allowed the termination of pregnancy in July. And as the case involved a substantial question of law, the Apex Court took it up for further consideration. During the course of hearing, Additional Solicitor General Aishwarya Bhati told the Supreme Court that the Rule 3BC extends to unmarried or single women who are in long-term relationships. The Government Council said that the term change of marital status in Rule 3BC of MTP ought to be interpreted as change in the status of a relationship to include unmarried or single women as well as women who are not divorced but are separated or have been deserted. She also told the court that live-in relationships are equivalent to marital relationships because in both types of relationships, the woman is entitled to maintenance. The bench comprising Justices D.Y. Chandrachud, A.S. Bopanna and J.P. Pardiwala held that Rule 3BC of the MTP rules cannot be interpreted in a restrictive manner to deny right of abortion to unmarried women beyond 20 weeks. The court also said that doing so would be violative of Article 14 of the Constitution, which promises the right to equality. The Apex Court said that the benefit granted by Rule 3B of MTP Act must be understood as extending to all women who undergo a change of material circumstances.
I will achieve, I will fly high. I
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The verdict coincided with the International Safe Abortion Day. Justice Chandrachud thanked the lawyer when he pointed this out after he finished reading the judgment. That's all for today. Catch the next episode of The Morning Show on Monday. Bye-bye for now.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.